First quarter exports and purchasing orders rose on the back of the global economic recovery. The Taiwan Institute of Economic Research has therefore revised this year's economic growth rate forecast from 1.74% to 2.04%. However, it believes the rate for the second half of the year will slide between quarters due to the high GDP base period last year. Brexit, uncertainties, a U.S. interest rate rise, and geopolitical issues.
The global economy is recovering and Taiwan's economy is benefiting. The Directorate General of Budget, Accounting and Statistics announced unemployment rate in March was 3.78%, and the number of unemployed fell by 10,000. Meanwhile, exports and purchasing orders rose between January and March. As such, the Taiwan Institute of Economic Research has increased this year's economic growth forecast from February's 1.74% to 2.04%. However, it cautions the rate for the second half of the year may slide between quarters. The reasons include a high GDP base period last year after exports experienced double-digit growth and the United States raising interest rates. The TIER says other factors such as the 2017 French presidential election, Brexit, and the North Korea nuclear threat may also affect growth. The government plans to invest 880 billion NT dollars in infrastructure over 8 years to mitigate the effects of global uncertainties. However, the TIER says the effects of the forward-looking infrastructure development program won't be felt in the short term. The start of a U.S. interest rate tightening cycle in the second half means hot money will flow back to the U.S. Taiwan remains on the U.S.'s currency watch list. Over the long term, large stock market fluctuations are expected. If exports do not experience double-digit growth in the second half, then it may be difficult for the GDP to exceed 2%.